The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box with Arabella Gamedi and myself, Steve Sedgwick, and these are your headlines. Hold, cut. The Bank of England and Norges Bank expected to stand pat today whilst investors eyeing a second consecutive rate cut from the Swiss National Bank. We're going to speak to the heads of the SNB and the Norges Bank later today. Another blow for the UK Prime Minister Rishi Sunak as polls suggest his Conservative Party is on track for its lowest ever seat total in the upcoming election.
Still in elections, the tussle for the key roles in Brussels takes a turn with Italian Prime Minister Giorgia Meloni's group securing enough new members to become Parliament's third largest party and claim a top job. Chinese automakers reportedly push for retaliation against European EV tariffs, calling on Beijing to hike duties on gasoline-powered imports.
Right, very good morning to you. You notice my tone in the first headline because the producers did something amazing as whatever, and they put a question mark in there. And have you ever tried reading a sentence with a question mark at the end? It's like, I'll just go through it again. It was like, hold, cut. And it was a question. It's a question. They've put my first sentence as a question. And it's the right question to ask, by the way, at the moment, because what on earth are central banks doing at the moment? Should they be hiking? Bank of Japan? Should they be holding, such as the Bank of England and the Fed appear to be doing, or should they be cutting, as we're getting from the Riksbank, the ECB, and the SNB? And the answer is probably yes. In all three, because the data is supporting evidence of all three doing that as well. So it's very, very interesting moment. We've got Christian Keller waiting in the wings from Barclays. They just put out this mega note, and so we'll get a good round robin in a few moments' time. But we are setting up for another Super Thursday of central bank decisions. At 9:30 CET, we're going to hear from the aforementioned Swiss National Bank, with markets pricing a 66% chance of a 25 basis point rate cut. It's second this year. The Norges Bank will follow at 10:00 CET with around a 30% chance of a 25 basis point hike. Before we hear from the Bank of England this afternoon, which is all but certain to keep rates on hold. So, Arabella's at the wall.
Question? Answer, yes.
I think he is, yes.
Answer is yes. Of course, we had that CPI print yesterday, right, Steve? And let's look ahead then to the Bank of England's decision. It's the final time then that we will be hearing from the central bank ahead of the UK's general election. That coming up, of course, on July the 4th. And it does come with that headline inflation print that we made note of then from yesterday. Now back at target, hitting 2% for the first time then since July 2021. Prime Minister Rishi Sunak claimed credit, again, as he has for a number of months now, for the country's falling inflation level.
A very positive step, shows that the plan we put in place is working. Inflation back to target. It was 11% when I became Prime Minister. I said it was a priority to bring it down so that people can start now to feel an ease in the cost pressures that they've seen. And it's because that plan has worked that we've been able to start cutting people's taxes. And this election is about the future. We want to build on this economic foundation that we now have. And I want to keep cutting people's taxes at every stage in their life. And in contrast, Labour would reverse the progress that we've made and just whack taxes up for everyone, and I don't want to see that happen.
But as we tried to make note of yesterday, it's mixed signals, though, from this data, because the top line figure is only part of the picture. Core inflation did remain well above target then at 3.5%, even as it fell from April's 3.9% level. And then on the other side, you had services inflation. That then even surprising to the upside. The market had anticipated a 5.5% figure. 5.7% though is what we got. Now, investors did reduce their bets on Bank of England easing, particularly after the data, not just necessarily for today's meeting, but really the meetings ahead. Markets see just a 1% chance of a move lower today and just under 45 basis points of easing for the remainder of this year, with the first fully priced in rate cut coming only in November now, is what they've put forward. Economists now also expect the Bank of England to go further, with 63 out of 65 polled by Reuters ahead of that data, the inflation number, expecting a rate cut in August, though. The outlook for the end of the year was a little bit mixed then, with investment banks as well then as economists largely split on whether we will see 50 or even 75 basis points of cuts this year, Steve.
Yeah, I'm still fascinated by the voting intentions today. I got to be honest. It was 8-1 was the expectation last time.
Yep.
It came in at 7-2. I think we're closer than the market thinks. A, from my conversations with the Bank of England and Andrew Bailey. B, from my actually being one of the few people who bothers to read the entire monetary policy report, because I get loads of time during the lock-in, so I do. And I think we're closer than many people think to a 4-5 vote or even a 6-3. I'm not saying we're going to get a cut this time round.
Yeah.
I agree. But just given that Andrew Bailey has said to me, it is my duty to cut if we need to cut rates, regardless of the political cycle. I asked him very specifically about those questions. I'm not saying it's going to be a great cut today. I don't think for 1 minute it will be, but I think it's going to be closer than people think.
Yeah, and I can actually agree with that. I think the one thing that probably writes off a lot of today is purely just because, well, how do you explain today's decision? Because you don't have the press conference, you don't have your projections also out as well. So August, maybe?
Yeah, I think that's very realistic.
Yeah.
Look, the UK Prime Minister, meanwhile, Rishi Sunak, has been dealt another bruising set of polls. 2 weeks away from the country's general election. One poll-based projection from Savanta forecasts the opposition Labour Party receiving 516 MPs out of 650, with the Conservatives falling to just 53. That is an extraordinary figure. That is a historic figure if it were to transpire. A YouGov poll-based projection for our sister channel Sky News sees Labour on 425 and the Tories on 108. That's a result that would still mark the Conservative Party's lowest ever seat total and Labour's highest. Barclays says it expects to see policy continuity in the UK, even with a Labour victory in the upcoming election, adding that such an outcome would be a boost for UK equities and sterling. Delighted to welcome to the show Christian Keller, who is Head of Economics Research at Barclays. Christian, your piece of research today is very deep and all-encompassing, and I've been on the portal Barclays and looking through it. I mean, so there's so many aspects in there. That's why we're going to chat to you again about a lot of it after the break. But let's start off, if we may, just because of the political and economic news out of the UK, on the UK. Just give us a round robin on the economics and the market and asset class implications of what's going on in the UK at the moment, sir.
I think the situation in the UK is that, as you say, that looks like we're going to have political change in the sense of there'll be another party. But I think markets are quite reassured that if you look at the fiscal front, which is always an issue now, also in other parts of Europe, obviously in the US, where markets are concerned about the fiscal outlook, we seem to get reassurance there's going to be continuity in the sense of a sensible fiscal policy. And I think markets, and us including, are looking forward to potentially the UK getting a bit closer back to the EU, meaning that could give somewhat of a growth impulse. And, you combine that with a lot of the risk premium that has been priced into UK assets, including, the sell-off we've seen in the pound since the referendum in 2016. I think that makes markets, and us including, a little bit optimistic on UK equity, but also on the performance of the pound, in particular against the euro in the coming quarters.
Excellent. Is there, though, a political risk premium attached to sterling gilt and, dare I say it, the FTSE? Because it's one reason why many people have been talking about the underperformance of all three of those financial instruments and asset classes as well. Is there still a risk premium attached, or are there other reasons why the pound, gilt and the FTSE have underperformed?
Well, I think overall, most people and most economists, but also markets, feel that, Brexit overall for markets has not been a great idea. But what you have now, if you look at the currency in particular, it's a relative price. And if I look at the pound, I've looked at the political uncertainty in Europe, also in the US, and suddenly, you mentioned the polls earlier, I think the situation in the UK looks for change politically, but not necessarily uncertainty in the sense of the polls seem to be quite clear. And there has been an ongoing messaging from the likely incoming Labour government that they want to play it relatively conservatively on the fiscal front, as I said. So relatively speaking, the uncertainty in the UK seems to be coming down if you compare it to the other main regions. And, premium is probably still priced in. As we've seen, there often have been surprises in the recent elections. But I think, as we look forward, the UK may be actually looking to shed some of that risk premium, if you want.
Yeah, I mean, Christian, then the question becomes, where are the green shoots, though? Because if we've highlighted, as we have now, all the difficult elements that are facing the UK, whether it be in forms of equity, currencies, and that risk premium that we're talking about, where do you find the positivity? Because the market keeps saying to itself, well, this market is still not what the investors would probably want to get into right now.
Well, as I said, I mean, it's not an all-in optimism on the UK, but I think everything in this market environment is about relative prices. Where is the positioning? And if you see how far markets in other areas have extended themselves, including US equity, etc., you look at those markets which have been lagging. And when you say where the green shoots, as I said, I think there is some hope that bringing the UK back closer to the common EU market, that would have some impact. I think we're already seeing some positive dynamics in some of the UK equity. And as I said, the currency should be helped by having been a currency that's been beaten up for some time now.
How important would the easing cycle be to the overall economics?
Well, easing does help. It helps, particularly on the UK mortgage market. You mentioned earlier the market pricing is quite hesitant about seeing any cuts. The first cut is priced for November. We remain a bit more optimistic. We think they can start in August. We think they may be even doing 3 cuts this year. That should help, and overall should help to give some cyclical upward momentum to the UK economy.
Christian, we hear a lot about the last mile of getting inflation and CPI, and within that, of course, services and wages down in order to feel freer from a central bank point of view to cut rates as well. It's proving really hard on a global basis. But if we specifically look at perhaps some of the decisions we're seeing in Europe at the moment as well, is it likely that 2% targets, which it's questionable whether 2% should be a target anyway, where they will be reached and maintained long enough to actually see a prolonged rate cutting cycle across Europe?
As you say, it has been difficult, and particularly in Europe, where we thought the economy is stagnant. There is a not very strong demand in contrast to the US, but we have seen that services prices, even on the continent, in the EU or in Europe, in the euro area, have been getting a bit stickier. And if we look at the wage demands in Europe, including from the IG Metall in Germany recently, they are quite high. And so you're coming from a situation where there have been real income losses in Europe because inflation was high and wages growth was slow. That is turning now, which on the one hand is good. It gives us some cyclical impulse in demand. So that should be good for Europe. We're seeing a gradual improvement in growth on the continent. But at the same time, it does make inflation stickier. And I think that is why the ECB, rightly so, is so hesitant. Our models still show that inflation is coming down gradually. But I think there's a lot of uncertainty now, in particular about the services inflation. The focus will be on the labor market, as we mentioned before. Indications are that it's loosening somewhat, but it remains very critical. And given the demographics, you have in Europe a lack of labor supply, which is something that keeps labor markets tight, even if you don't have the kind of demand dynamics that you have in the US.
Christian, I was speaking to actually Charlotte, our French correspondent, about what is actually going on in France at the moment. And actually, we were comparing it to what happened in Great Britain in 2016. It's not a Brexit moment in France. Absolutely wrong to compare them in the same terms. But it is a moment where France is looking at itself and seems incredibly split along the lines of the schism we saw in the United Kingdom at that kind of time. Does it have the ability to derail Europe economically and certainly some of the asset classes there? Because that is the attitude that many in the market are taking. They're like selling now, going for safety and having a look from the outside.
I think that is a fair comparison. It's as you say, this is not about a French exit. I think even Le Pen's party has by now moved away from the idea of leaving the EU or leaving the euro area, but it is certainly a concern about fiscal developments in France. The country has 110% debt to GDP, and France has no history, no record really of being able to adjust the fiscal deficit. And we think markets, rightly so, have been concerned about the fiscal outlook. Markets have sold off the French debt, the spreads towards the bunds. The German debt have been at record highs now, and it's record highs in the sense of, I think it's over 10 years ago that we've seen spreads like this. And we continue to be concerned because if you look at the outlook, either from the far right, who could gain a majority at the next election, or at the alliance of the left, which has even a worse fiscal outlook, if you want, that is concerning for markets. And we agree. We think we continue to be skeptical on French debt, and then I think by extension that weighs obviously on other assets, on equities as well. If you think about future plans, possibly on taxes, etc., that has been weighing on banks in particular. And we think that is something to take serious. And the comparison to the UK is interesting because in both situations we had a sudden decision in a way to force the market or force voters to make a decision which then backfired. And that looks scarily a little bit like the Brexit referendum now in France with the snap elections.
Christian, that's great, and we appreciate you so much. In fact, so much so, we're going to ask you to hang around just over the break, and then we'll come back. And I actually want to talk globally, because you've had some really interesting comments on China and the US consumer. So we'll do that if you would wait with us after the break. Thank you, Christian. In the meantime, we'll be across all three central bank decisions today out of Europe. At around 1200 CET, we're going to hear from the SNB chair, Thomas Jordan. 13:30 CET, Sylvia will be speaking live, actually, to the governor of the Norges Bank. That's Ida Woldenbacher. And Sylvia will be bringing you special programming for the Bank of England's interest rate decision. So when I say we, I mean Sylvia. Coverage starts just before that decision at 1200 BST. Arabi.
Here's something that we will be doing, however. We'll be focusing on China's central bank, which has kept benchmark lending rates steady. We'll have more for you after the break on that one. Plus, Europe's carbon market may be at crossroads, according to new research by Goldman Sachs. We'll discuss where further opportunities are with our guest this hour. And our countdown to the UK election continues. We'll be speaking with Alistair Campbell, the former Director of Communications and Strategy for the Labour Party. Tune into that interview at 8:30 CET.
Ambition to me is about doing better.
I think ambition creates a pathway.
The best advice I can give to someone starting off a career is don't have a career, have lots of careers, try loads of different things.
Talk to people and put your ambition out there.
I don't feel that I've hit peak ambition because it's a learning journey.
CNBC is where ambition meets opportunity. What does living ambitiously mean to you? Hear it from our CNBC anchors, reporters and global business leaders on CNBC.com.
Now, despite US markets being closed yesterday, of course, for Juneteenth commemorations, we had still been looking towards that bond market and just, of course, the rate cutting expectations then still within this market picture. You're seeing the 10-year note draw down quite considerably then and now sitting at 4.2517, in fact, with the 2-year at 4.73. That actually been a slight uptick on that, but right now seeing it much lower than where it was, of course, a little bit around last week, 4.5 nearly for the 10-year and nearly 5% even for the 2-year, as we had seen. That retail sales data has also softened, adding a little bit to this market. Onto the dollar crosses then as well. The pound is broadly steady then, particularly ahead then of the Bank of England's decision later today, anticipated, of course, to hold interest rates. 127.08 is where we're sitting there. So we will be looking at that one across the day. The dollar, on the other hand, though, seeing it right now, you also just see a little bit of strength, should I say, then ahead of the decisions coming out of Europe in particular. On the yen, 158.17 is where we're at right now. Just also, that isn't too far off from the 1 month low that we had seen of 158.25. That was hit just last week. On the Asia market front, well, down it looks for the most part. They're mostly lower. China keeping its 1 year as well as its 5 year loan prime rates unchanged. Then stocks still near their highest in 2 years as traders await more US policy rate news. Then down 0.5% then for the Hang Seng. Steve.
China's central bank kept benchmark lending rates steady in line with expectations. This as the PBOC continues to walk a tightrope, despite recent economic data showing more support might be needed. New home prices in the country, wow, this is really interesting, declined at their fastest pace in nearly a decade last month, according to official data. Do you know, I'm going to spend a bit more time on that, just a second, because the amount of time we've been told that the consumer crisis is plateauing and near its end in China, this one sentence blows that out of the water. New home prices in the country declined at their fastest pace in nearly a decade last month, despite everything that's been thrown at it, according to official data released this week, despite efforts to rein in supply and support struggling developers. I find that fascinating and slightly worrying as well. Arabile.
Well, the disappointing data out of China should be offset then, particularly by what is a strong growth in the United States and India, according to Barclays. In its latest Global Outlook report, the lender expects the world economy to grow 3.1% this year and says investor concerns about the strength of economic expansion, in particular in the United States, are overdone. Christian Keller is still with us then this morning. Christian, you're talking about those concerns being overdone, particularly with some weakness being shown in the US economy. You think there's still strength here, that that softening is to be expected considering the rate hikes we had seen?
Yes, I think we have to distinguish among the regions, as you said. I think in the US, the debate about a slowing economy has been going on for some time. And mostly you see those who are thinking that we maybe have a very quick slowdown coming soon are looking at some of the survey data. If we look at data in particular on the labor market, which we believe is ultimately the engine of this US economy, it's the engine of domestic demand and in particular consumption demand, that continues to be quite strong. This job market in the US is still creating around 250,000 jobs a month. If you look at it on a 3 months, 6 months, 12 months basis, that has been the rate. That keeps the payroll expanding, meaning the money that the households take home, that's still growing at 5-6%. And that we believe is really what matters here. And we are not denying that the economy is slowing, but we believe it's still quite resilient. In particular, the consumer. There have been very large net wealth effects. You mentioned the equity market earlier. Obviously, that's unevenly distributed, but that's always the case. We also have a housing market that is already improving despite the rate hikes, and that gives people also a lot of net wealth. Households expanded their net wealth. They have jobs. We think they continue to consume, and that should be the backbone of the US economy, which is different from China. But you let me know if you want to go into that. You mentioned it earlier.
Yeah, we'll go into a little bit of that just now. But I wanted to just point as well to, you had been pointing around as particularly equities right now as well, and just made note of how, it's really concentrated, particularly with maybe even some would say 5 stocks, really. Does that not become worrisome that you don't necessarily have the kind of broadening out that was spoken about at the start of the year?
I think if you look at valuations, if you look at positions, if you look at how long the stock market has been rising, it would be strange if you weren't becoming concerned. And one thing we think at the moment, for example, one should start hedging these equity positions. But at the same time, it's very difficult to go straight out against equities. Earnings, in particular in those sectors you mentioned, in some of those high-tech stocks, chip-related stocks, they've continued to perform. The earnings surprise often on the upside. They continue to deliver. So it's difficult to say in this environment that is overdone, but it's certainly a very, very concentrated rally. And looking ahead, looking at the political uncertainty also in the US, we think it becomes more and more tenuous, and one probably should hedge some of these positions.
Okay, Christian, that's great. Let's talk about China. I read that line twice because for me, that is not a line being drawn in the sand. Chinese consumers who have money just don't want to spend at the moment. They just see concern about what's happened to them economically, and they just don't want to spend. They don't want to increase more debt as well. This is a problem for the authorities, isn't it?
It certainly is. And what we have is an ongoing property slump. It started a few years ago, so I think people often expect this should end soon. But this has been a massive rally, if you want, in real estate in China over a long time, over a decade. This has been the driver of growth. And now this has come to an end, and it takes time. And what we saw today, again, with the rates decision, the government and the authorities in China, they want to avoid a deeper crisis, but they're not willing to give the big stimulus maybe that would be needed. So meaning we're seeing a slow grind, and we're seeing elements of the debt deflation spiral. And I don't want to exaggerate. It's not maybe Japan in the 90s. But what we do see is exactly what you said. Households by now have accumulated a lot of debt, but the underlying asset that they bought, apartments, etc., those prices are falling. So they're now trying to save more. They don't want to spend. Developers obviously are in problems. And that has become a weight on the Chinese economy. And we don't think that's turning around quickly. And that's why we believe China, after a pretty strong first quarter, is probably going to slow in the coming quarters.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.